The tariff math. How foreign exporters are cutting prices. Here's a puzzling economic mystery that's been on my mind. How is it possible that the U.S. is simultaneously generating significant revenue from tariffs, experiencing nearly stagnant inflation, and seeing a stronger economy than many anticipated? This situation seems counterintuitive because typically, when companies face high tariffs, we're talking over $100 billion in duties, they are left with two options. They either pass these extra costs on to consumers by raising prices, which would push inflation higher and make it stickier, or they choose to absorb the tariffs themselves, which cuts into their profit margins and could lead to slower hiring or even layoffs. Yet, interestingly, none of these expected outcomes have fully played out so far. This conundrum was at the heart of a discussion I had with Treasury advisor Joe Lavorgna on CNBC's Power Lunch. We tried to unravel why the usual economic logic seems to be breaking down in this case. Here's where it gets even more intriguing, and certainly controversial. The answer might lie with foreign exporters themselves, who appear to be lowering their prices to compensate for the tariffs. Take the Japanese auto industry as a vivid example. In June, Japanese car manufacturers reportedly cut prices by an eye-popping 19% on vehicles shipped to North America. Similarly, factory prices in China fell by 3.6% last month, marking the steepest decline in 2 years. What this means is that exporters abroad are effectively absorbing some of the tariff costs by reducing the prices they charge, rather than simply passing on the tariff burden to the U.S. businesses or consumers. Let's break this down with a simple illustration. Imagine an imported product that cost $1,000 last year. Now slap a 20% tariff on it, which should theoretically push the cost up to $1,200 for buyers here. But what if the exporter cuts their price by more than the tariff increase? Suddenly, despite significant tariff revenue flowing into the U.S. government, which now ranks as the fourth largest income source, consumers don't see a price rise and companies don't necessarily suffer margin losses. This juggling act helps explain the surprisingly mild impact tariffs have had on both inflation and the broader economy, at least so far. Goldman Sachs has also been surprised by how little tariffs have disrupted economic activity, estimating that foreign exporters have absorbed about 20% of the tariff costs. The remaining costs are split between businesses and consumers, but interestingly, a smaller share of these costs is currently being shifted to consumers compared to the first Trump administration's tariff cycle. Initially, it seemed U.S. companies bore the brunt, which triggered a sharp negative reaction in stock markets back in April when tariff hikes were announced. Over time, however, more costs have been trickling down to consumers, up from 0% passed on at the start to approximately 40% by the third month, according to Goldman. If this trend continues, economists predict that the core personal consumption expenditures, PCE inflation rate, which is closely watched by the Federal Reserve, could rise to 3.3% by December, up from 2.7% in May. So here's the kicker. The feared stagflationary effect of tariffs, a dangerous mix of stagnant growth and rising inflation, is still very much on the table as a possibility. But as it stands today, the tariff impact appears to be spread thinly across exporters, consumers, businesses, and even currency fluctuations, minimizing its overall sting. Joe Lavorgna is clear on this. Tariffs are not inflationary. They will be absorbed in foreign profit margins. If he's right, the markets and the Federal Reserve will breathe easier. But if tariffs start pushing inflation higher again, it could signal tougher times ahead. This economic puzzle is far from solved, and the next few months will be crucial in revealing whether this unusual balance can continue or if the long-feared inflationary pressures from tariffs will finally make their presence felt. What do you think? Are exporters quietly absorbing these costs at an unsustainable level? Or is this a new model for how tariffs affect economies moving forward? Does this mean the classic inflation model tied to tariffs is out of date? Drop your thoughts below. I'd love to hear your take on this complicated and critical issue. See you at 1 p.m. Kelly. Follow me on Twitter at KellyCNBC. Follow me on Instagram at RealKellyEvans. How Trump's tariffs are screwing over American businesses and consumers. Let's face it, when governments impose tariffs, the question of who ultimately foots the bill is often more complicated than it seems. Spoiler alert. It's rarely the foreign companies being targeted. In this case, it's American businesses and consumers who are bearing the brunt of Donald Trump's trade policies. And here's where things get even more intriguing. While these tariffs were designed to protect domestic industries, they're increasingly showing signs of backfiring in ways many didn't anticipate. Take General Motors (GM), for example. The iconic automaker recently revealed just how hard these tariffs have hit their bottom line. GM disclosed that its profits took a staggering $1.1 billion nosedive due to the added costs from Trump's tariffs. Rather than passing those costs directly onto consumers by raising car prices, GM chose to absorb much of the financial blow itself, at least for now. This decision helps explain why recent inflation data shows little movement in car prices, even as other imported goods like toys and appliances saw noticeable price hikes. But here's the twist. GM isn't alone in feeling the pinch. Other US-based companies are quietly grappling with similar challenges, though few have been as transparent about the impact. For instance, robust price increases for everyday items such as electronics and furniture suggest that businesses are indeed passing along the extra tariff-related expenses to shoppers. What does this mean for you? Well, if you've noticed your household budget tightening lately, tariffs might be playing a bigger role than you realize. GM's earnings report painted an even clearer picture. On an adjusted basis, the company reported earnings of $2.53 per share, which beat analysts' expectations of $2.33, but still fell short of last year's impressive $3.06 figure. While GM managed to outperform forecasts thanks to strong truck demand, the lingering effects of the tariffs loom large over its future profitability. Perhaps most telling is the fact that GM offered no immediate solution or timeline for returning to pre-tariff profit levels. And this is the part most people miss. Tariffs aren't just abstract policy decisions made in Washington. They ripple through every corner of the economy. From manufacturers trying to keep production costs down to families shopping for back-to-school supplies, everyone feels the impact one way or another. Yet, despite the growing evidence pointing to the unintended consequences of these tariffs, debates continue to rage. Are they truly protecting American jobs and industries? Or are they simply creating new headaches without solving old problems? So what do you think? Do the benefits of tariffs outweigh the costs when everyday Americans end up footing the bill? Is there a better way to support domestic industries without burdening consumers? We'd love to hear your thoughts in the comments below. Trump tariffs. Who really pays? Impact on U.S. companies and consumers. Who is truly bearing the financial burden of Donald Trump's tariffs? The answer is clear. It's American companies and consumers who are feeling the pinch. In a recent announcement, General Motors Company revealed the significant impact these tariffs have had on their bottom line. The automaker reported that the tariffs have resulted in over $1 billion in additional costs, which they have opted to absorb rather than pass on to consumers. This decision sheds light on why car prices remain stable in the latest inflation report, even as we saw substantial price hikes in other imported goods, such as toys and household appliances. These items have seen their costs rise, indicating that the burden of tariffs is indeed being transferred to consumers in those sectors. But here's where it gets controversial. While some companies choose to absorb these costs to maintain competitive pricing, others are not so generous. This raises an important question. Should businesses prioritize their profits over the financial well-being of their customers? As we navigate this complex landscape, it's essential to consider the broader implications of these tariffs. Are they truly protecting American jobs? Or are they simply leading to higher prices for everyday goods? We invite you to share your thoughts in the comments below. Do you agree with the strategies companies are employing in response to these tariffs? Or do you think they should handle the situation differently?